You're 52 years old. You have maybe $40,000 or $50,000 saved for retirement, and you just found out the IRS quietly raised a limit that could let you shelter an extra $7,500 this year, on top of the standard $23,500 everyone else gets. Most people walk right past this. According to Vanguard's 2024 How America Saves report, only about 15% of eligible participants actually use the age 50 catch-up provision. 15%. That means roughly 8 out of 10 people who could be supercharging their savings simply aren't. The IRS calls it the standard catch-up contribution. It kicked in the year Section 401k of the tax code was amended to allow it, and in 2026, it's worth $7,500 on top of the base $23,500 limit. That's a combined ceiling of $31,000 for anyone 50 or older. This video is going to show you exactly how it works, how it interacts with your IRA, and what most late starters get wrong about deploying it. Let's get into it. How the standard catch-up actually works. The mechanics are simpler than most people expect. The moment you turn 50, the IRS flips a switch. You are now eligible to contribute an additional $7,500 per year to your 401k, or your 403b, or most governmental 457b plans, on top of the standard elective deferral limit. For 2026, the IRS confirmed the standard limit stays at $23,500. Add the $7,500 catch-up, and your total ceiling is $31,000. That's per person, not per household. If you and a spouse both work and both have access to employer plans, you each get that $31,000 ceiling independently. Here's the part most people miss. You do not have to wait until your birthday month. The IRS looks at whether you will turn 50 at any point during the calendar year. If your 50th birthday falls on December 31st, you can still make catch-up contributions starting in January of that same year. The eligibility is year-based, not date-based. Your employer plan has to allow catch-up contributions, and almost all do. But confirm this with your HR or benefits department. The plan document controls. If your plan somehow restricts it, that restriction is binding. One variation worth knowing: if you're in a simple IRA instead of a 401k, the catch-up limit is different. For 2026, the simple IRA catch-up is $3,500, not $7,500. Same age 50 trigger, lower dollar amount. Your plan type matters. The IRA catch-up. Interaction. Now here's where the strategy gets interesting, because the 401k catch-up does not operate in isolation. You can also make a catch-up contribution to a traditional IRA or a Roth IRA if you're 50 or older. For 2026, the standard IRA contribution limit is $7,000. BAUL and the catch-up adds $1,000 on top of that. So your IRA ceiling at 50 plus is $8,000. The right move is to stack both. Max your 401k catch-up and max your IRA catch-up in the same year if your cash flow allows it. Together, that's $39,000 in tax-advantaged space in a single calendar year, $31,000 in the 401k, $8,000 in the IRA. Now, individual variation matters here. Whether you use a traditional IRA or a Roth IRA for that $8,000 depends on your income and your tax bracket. If your modified adjusted gross income is above $165,000 as a single filer in 2026, your ability to contribute directly to a Roth IRA starts to phase out, and it disappears entirely above $180,000. Married filing jointly, the phase-out runs from $246,000 to $256,000. The IRS publishes these thresholds annually. If you're above those income limits, the traditional IRA route may still work, though the deductibility of a traditional IRA contribution depends on whether you or your spouse are covered by a workplace plan. The IRS phase-outs for traditional IRA deductibility start at $79,000 for single filers covered by a workplace plan in 2026. At higher incomes, you may still contribute to a non-deductible traditional IRA, and some people use that as the first step in what's called a backdoor Roth. That's a separate conversation. But the point is, the IRA catch-up doesn't disappear just because your income is high. Your options shift. The option doesn't vanish. A full worked example. Let me walk through the numbers so this feels real. Say you're 54 years old. You earn $95,000 a year. Your employer offers a 401k with a 3% match on the first 3% you contribute. You are single and file as a single taxpayer. First, you want to capture the full employer match. 3% of $95,000 is $2,850. That match is free money. The data is clear on this. According to Vanguard, employees who fail to contribute enough to capture the full match leave an average of $1,336 per year on the table. Do not leave that on the table. Now, after capturing the match, you want to fill the rest of the 401k ceiling. In 2026, your total limit is $31,000. You've already directed $2,850 of your own money toward the match threshold. You can go all the way to $31,000 with your own elective deferrals. The employer's $2,850 match does not count against your $31,000 limit. Employer contributions are tracked separately under the overall Section 415 limit, which in 2026 is $70,000. Your personal ceiling is $31,000. So if you max out your 401k, all $31,000, and you're in the 22% federal bracket, you've just reduced your taxable income by $31,000. That's a federal tax savings of roughly $6,820 in the year you contribute. State taxes vary by where you live, but in most states, traditional 401k contributions are also pre-tax, so the real savings are often higher. Then you stack the IRA. You contribute $8,000 to a Roth IRA. At $95,000 of income as a single filer, you're well under the Roth phase-out threshold, so you qualify. You don't get a current year deduction on the Roth, but the growth in qualified withdrawals are tax-free in retirement. Total tax-advantaged contributions for the year, $39,000. On a $95,000 salary, that's over 41% of gross income going into protected accounts. That's not a radical sacrifice. That's a deliberate shift in priorities. The biggest mistake late starters make. I research retirement strategy for a living, and the single most common mistake I see is this. People treat the catch-up contribution as a bonus for the rare year when they have extra cash. That mindset is exactly backwards. The catch-up is not a bonus. It's the baseline plan. If you're behind, the catch-up is not optional. It's the mechanism Congress specifically designed for your situation. Here's what I'd do. Build your budget around maxing the catch-up first, then live on what's left. That's not intuitive. Most people budget for expenses and contribute whatever remains. But if you're in your 50s and behind, flipping that order is the single highest leverage change you can make. The math supports this strongly. Vanguard's modeling shows that someone who starts maxing the age 50 catch-up at 52 and contributes $31,000 annually through age 65, assuming a 6% average annual return, accumulates roughly $580,000 from those contributions alone. Start at 55 instead of 52, and the same math produces roughly $390,000. 3 years of delay costs about $190,000 in that scenario. The contribution window is finite. Every year you undercontribute is a year you cannot recover. One more edge case that trips people up. What if you change jobs mid-year? If you contributed to a 401k at your old employer and then joined a new employer's plan in the same year, your total elective deferrals across both plans cannot exceed the combined limit of $31,000. The plans don't communicate with each other. You are personally responsible for tracking this. If you accidentally overcontribute, you must withdraw the excess plus earnings before the tax filing deadline, or you'll face double taxation on that amount. Your tax professional can walk you through the correction mechanics, but the cleaner solution is to track your year-to-date contributions carefully whenever you change employers. What I'd do if I were starting over at 52. My take is straightforward. If I were 52, behind on savings, and had access to a 401k with any employer match, here's the sequence. Capture the full employer match first, always. Then direct every additional dollar toward maxing the $31,000 401k ceiling. Then fund the IRA to its $8,000 catch-up ceiling, choosing Roth or traditional based on where my income falls relative to the phase-out thresholds. If I couldn't max all of it in year one, I'd set a target to increase my contribution rate by 1 or 2 percentage points every year, ideally timed to coincide with a raise, so I never feel the reduction in take-home pay. That incremental ramp is a documented behavioral strategy. Vanguard's Save More Tomorrow. Research showed that auto-escalation dramatically increases final balances without triggering the psychological resistance that comes with large immediate cuts to spending. The point is this: the catch-up provision exists because Congress acknowledged that life gets in the way. Career gaps, medical costs, supporting kids or parents. These are real. The $7,500 is an acknowledgement that some people need more runway. Use it. Disclaimer and next steps. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this video helped you, subscribe. There's a lot more coming on exactly this kind of late start strategy. And next week, we're going into your most powerful decade for building wealth. The 6 retirement moves to make between 50 and 60 when you're starting behind. That one is worth sticking around for. If there's a specific retirement question, Roth conversions, Social Security timing, anything on your mind, drop it in the comments below and I'll work it into an upcoming video. This video may contain affiliate links. I only recommend tools I use personally.